Good afternoon. Chair.
Hello, everyone. Can you hear me?
I can.
Yes, I can hear you.
Okay, great. Good afternoon, everyone. It is exactly 2 o'clock. Thank you for joining our capital market session. Thank you to the SBL for organizing this, and I would just like to recognize the presence of our SBL chair, Dr. Adeoye Adefulu. Not to take too much of your time, we'll just go straight into it. I would introduce our moderator shortly, but I just thought I'll give a little bit of background on why we are hosting the session with this topic today. So in deciding on what topic to pick, we looked at the current trend in our sector. And of utmost importance right now is the banking recapitalization exercise. In particular, the deadline to meet that recapitalization requirements. And we realized that a number of our members are directly involved in this exercise, either by being a party to a capital raise and mergers and acquisition, and some are indirectly involved, maybe through articles they are putting out or roundtable discussions and general knowledge sharing. And we find that there's a bit of limited information available due to the confidentiality requirements of this transaction as they are ongoing. So we just thought we'll put together a panel of panelists that are experts in this area, share information. It's not just the banking and financial sector that is involved. We have the regulators, we have the government and private sector. So on that note, we have a panel that cuts across all of this. We have practicing lawyer, we have representative from the banking industry, and a representative from the financial advisory sector. So I would introduce our moderator for today and hand it to her. So moderating today, we have Ida Gregory. She's an intermediate associate at Gray Chapel Legal. She offers legal support in the corporate and commercial practice team. So Ida, over to you.
Thank you very much, Madam Chair. Good afternoon, everyone. Thank you once again. I'll say the name of the topic again. So it's titled Recapitalization of Nigerian Banks, the Role of Capital Markets. Before moving ahead, I'd like to recognize the chairman of NBA-SBL, Dr. Adeoye Adefulu, the council members, and once again, the chair of the Capital Markets Committee, Ms. Bukola Olabi. So a bit of context. As many of us are aware, the Central Bank of Nigeria recently mandated banks to increase their capital requirements across the different license categories and gave them a deadline till March 2026. This is to strengthen our capital system, our banking system, and also in alignment with the current administration's ambition to achieve a 1 trillion naira economy by 2030. So now banks face the pressure of increasing their capital requirements, maintaining their day-to-day operations, and still keeping their shareholders happy. So CBN gave the banks a deadline to submit their recapitalization plans, which was in April. Some banks have submitted and some banks have actually started the actualization of those plans. So in doing justice to this topic, our panelists will, amongst others, share their perspectives on industry trends and current market dynamics, and also talk to us about some capital raising strategies. I look forward to this session as much as everyone here. And it is my pleasure to briefly introduce each of them as we kickstart the conversation. So today we'll be adopting a ladies first approach, starting with the only other lady in this session, or the only lady in the panel, Aramide Oyineye. Aramide heads the legal function at Chapel Group in Nigeria and Ghana, where she provides legal and transaction support on investment banking and financial advisory transactions, investment management transactions, and securities and trading transactions. Welcome, Aramide. Next, we have Ayodeji Oyetunde, who is a partner in the capital markets and mergers and acquisition practices of ALN Nigeria, Alukwan Oyebode. Welcome, Ayodeji. And last but definitely not the least on the panel is Bimbo Oyiga, the head of mergers and acquisition and corporate finance for Rand Merchant Bank in the West African region. Welcome, Bimbo, and welcome, speakers, and thank you for taking time out to do this today. Just a bit of housekeeping before we proceed. Please note that we'll be taking questions at the end of the session, so you can note your questions and put them in the chat box while the session is going on. And please ensure that the questions are clear and brief so we can go through everything at the end. Without further ado, we'll start with the first question, which I'm directing to Aramide. Like I mentioned earlier in the background, this is a live issue as the recapitalization process is going on. So my question to you is, what key trends and issues are participants observing in the market? And which primary capital raising instruments are being leveraged?
Thank you, Idai, and thank you for the very good introduction into the subject matter. I think your two questions are, what are the primary capital raising instruments that are being leveraged? And I think I would start with just going back to how you introduced this subject matter, whereby you had said that the CBN has asked that the minimum capital be increased. And I think if you look at the CBN circular in specific, it actually defines, and there are stringent definition as to what components of capital are required to be increased. So in terms of the primary capital instruments, you can have both the equity and the debt, but taking into account the need of the CBN or the request of CBN, most of the banks are leveraging on the equity raising equity instruments, which could either be by way of a rights issue, which is the issuance of or the offering of new shares to new shareholders, or to the existing shareholders, or the public offer, which is by way of offer for subscription, which is offering of the new shares to the public or the general public, or private placement, which is offering of shares to a select group of investors. As you can see, you'd see that most of the trends in the market have been leaning towards having the public offer, although some people are also playing the rights issue space. Thank you.
Thank you very much. And why, from your experience, why would you say that majority have been leaning towards the public offer, which is, we've been seeing it with some banks currently doing that now, but is there something else informing that decision and why all of them are doing that, or most of them started doing that?
I think the general perception of the market is just ensuring that, so at the end of the day, the objective is to raise capital. So however we raise it, and I know we have been seeing an increased use of public offer, but we should not be surprised that though they started with public offer, you can also see them do rights issue down the line. So what we've seen is a staggered or phased approach to capital raising, whereby people start with public offer, the reason being, and I think some of the challenges with rights issue in Nigeria is the data identification or tracement of the shareholders. So we have seen that the database of shareholders have been stale, and it has been quite difficult tracing it. And we all know that in the event, in event that the rights are not fully taken up to 50%, we can see that can be aborted. But notwithstanding, doesn't mean that the public offer doesn't have its own challenges. But what we've seen in the market is that it's easier to raise from the investors generally, rather than limiting it to your own, to your existing shareholders. But that also has its own challenges in the event of dilution of existing shareholders.
Thank you very much for that, Aramide. Just moving to the next question, and I would like to direct this to Bimbo. How do you anticipate the macroeconomic challenges now, such as high inflation, foreign exchange instability, and the high interest rate environment? How do you anticipate that this will affect the bank's ability to raise capital?
All right. So just to check, can you hear me?
Yes, I can hear you.
Thank you for the question. So So similar to how you think macro, so some of the things you already mentioned, inflation, FX, interest rates impact our spending or production decision when I'm talking about a company. They also have, an equal or even an outweighed impact on investment decisions. So, the way you think about it is you look at it in two ways. So on one hand, you have your local investors, and in your local investors, you have your retail and your institutional investors. Your local investors have been under pressure in terms of spending. So when you think about it, inflation has been at elevated level for the past few months. What that means is, in terms of your discretionary spending, you can imagine what the impact is. So you are having a lot more spending on food and other items, and what is left over in terms of saving or investment is much lower. So as an overall bucket, the pool of capital from your retail is already under pressure. When you then think about it from an institutional standpoint, your institutional investors are always looking to chase yields and returns, which they need to demonstrate to their investors. And these institutional investors, they are obviously have the flexibility in terms of what they can invest in. So on one hand, you have a debt instrument, you have interest rate at elevated levels as well. So there is, on the downside, there's the opportunity cost of capital in terms of thinking, would I rather do an equity investment or do I rather do a debt investment which has lower level of risk, and the yields are much, much higher. At least you can almost solve for it from day one because you can already predict what the outcome will be. So already that starts to shape how your local investor dynamics and their own investment decisions will pan out. And then on the institutional side, on the other hand, the key thing for them has always been the FX dynamics and how impact their returns. So the key thing for them, they'll be trying to solve for is what is the ability that I can get $1 into the country, and when I'm leaving, I'm getting $1 plus X% return, whatever, when I need to exit. So already those guys will already start to price that into how they think about investments, and it also shapes, what they are looking to do. So I think you can almost not decouple the macro investments, the macro landscape from how people think around investments. But for banks, what you really now try to solve for is how do you manage this? And the way you think about it is, and this is me talking around the bank, is really focusing on your own story, because on one hand, you really cannot differentiate yourself because you operate in Nigeria, so you are exposed to the dynamics of Nigeria. However, what you can do differently is really how you position yourself to be as a resilient business vis-a-vis, what the macro backdrop is. So if, for example, historically, you've averaged out, say, in terms of total share, in total appreciation, so both yields on dividend and share price appreciation, you're averaging something very quite solid, upwards of 20%, whatever it is. You can go to the market and almost tell them, see, I'm a resilient business. My balance sheet is solid. I've been able to outperform whatever you would get on the debt side. And from a real rate of return perspective, so which is vis-a-vis inflation, I'm already on a positive side. It's a better and more appealing story where investors can really buy into that. But if the reverse is the case, let's say, historically, the business hasn't performed to that same level where you are having real rate of returns, etc., your story then needs to change to, okay, going forward, this is what I intend to do with raising capital. And the result of using the capital is 1, 2, 3, 4, 5, as the case may be. So already you are shaping investment decisions and you are shaping the mind of people to really buy into that story. And I think the other element as well, to also in terms of how you manage some of the macro backdrop is also investor education. And I think, the NGX on its own side is doing a lot of that. And just making it seamless and easy for people to be able to subscribe for this share. So, historically, where you'd have had to call a stockbroker, etc., to do this kind of subscription, and you really have it on the palm of your hand to undertake an investment. I mean, those small things also matter because it just removes some of the, I would call them administrative overhang in making decisions. So you really can't solve for your macros because you can't control that. But what you really should then be focusing on is your own business itself, our resilience. And I think that's what banks are already doing currently in terms of, you see a lot of banks that have already had like the fact behind the issue on the NGX, and the way they have told their story is really focusing on themselves, acknowledging the macro backdrop, but focusing on themselves, focusing on their business. And I think that goes a long way ultimately in terms of how these investors then make their own decisions.
Thank you very much, Bimbo, for that enlightening answer. I'll just, for like a minute, Aramide, I would like to hear your view on this as well, just considering your background. That's how, because you're coming from sort of like the investors side. So I'd like to see, I'd like to hear your view rather on that for just like a minute, if you could just chime in. Thank you.
I guess, sorry, my view on what
on the question, okay, yes, how the macroeconomic headwinds that are currently going on, how that would impact banks' abilities to raise capital.
So I think largely aligned with what Bimbo has highlighted, and I think just to add a few more context, and this is what we've as issuing houses, when we speak to proposed investors, this is what we see and this is what we find. Nigeria still remains a very major market for investment in Africa. So regardless these headwinds and regardless the declining FDI flows which we have seen, we actually still believe, and people still believe, in the Nigerian story, which some may say is triggered by the lower valuation, which is caused by the devaluation of Naira. So regardless, that opportunity still is subsisting, and having that higher returns that we see in the banking sector and that stability that's evidenced in the banking sector, I still believe that this sector would remain attractive both for FDIs and even investors locally. So as Bimbo has said, and something that's been a common theme in the prospectus or in the offer document, you would see that there's a very strong and compelling equity story, as where they are highlighting the bank strategy, highlighting the use of proceeds, and highlighting the potential of returns. These are attractive. This is what investors want to know. So this is the story that banks are feeding, and I think they're doing it very well.
Very much, Aramide. Yes. Still, this kind of segues to my next question. So just to direct it to you, how would you say the private capital market compares to the public market in terms of pricing and opportunities for capitalism?
So I think the perception of pricing from the side of the issuer as well as the side of the buyer is very broad. However, what you find with the private market is that there is pricing transparency because of the efficiency of the market, which is lacking in the private capital. So we have that constraint in discovering or ascertaining prices of securities. But notwithstanding, there is still a latitude of negotiating prices or on pricing in the private capital. However, in order for it to be a fair deal, what we tend to find is that there will be a trade-off, in the sense that in order for you to get that latitude on pricing, what are you giving me in return? So we would then see certain instances whereby there can be a loss of or a reduced sense of control. You're giving them certain seats on the board. You're giving them certain interest to actually to justify that latitude on pricing. Also, what we find with the private capital is because of the limited, reduced liquidity as against to the public market, investors are putting a premium to the pricing. The question now is the bank willing to take that premium? But you remember that the objective of the bank, notwithstanding how the capital is raised, is for us to raise that capital. And I think the private capital actually provides that environment whereby you have bilateral agreements with investors without having the public market burden of having to ensure preferential treatment of all shareholders. Do you see what I mean? So there is that latitude in the private capital market as opposed to the public capital market. But it doesn't take away from the public capital market, given the depth of the markets and the breadth of the market in raising that needed capital.
Thank you very much for that. Now moving slightly to the regulators. So this is there's been previous capital increase exercises, and now this SEC has demonstrated, or they are demonstrating, that they are ready to leverage their experience from past recapitalization efforts. So my question now is to Ayodeji. What are the potential implications of the bank recapitalization on the broader financial system, and how can the SEC ensure a smooth transition?
Okay, thanks a lot. I think that the SEC has indicated that they're going to support the capital raise process, but depending on where you are. So the last question was about public and private markets, and depending on who was trying to raise the capital. So for instance, now for some of our more prominent publicly quoted banks, you can see that they're very active in the public space, like Karamide said. But for some of our more privately held banks, so for instance, some of the international banks, they're probably looking at the more private market, or it might even be that it's just a situation where a parent offshore is downstreaming the fund. The reason I make that point is that it's not only about the SEC. You know, there are other regulators in the space, and collaboration is key. You have the CBN, obviously, who keep the ball rolling. You have the SEC, applicable to all publicly owned, all public banks. Then you have the NGX for those banks that are listed, and then you also still have the CAC for all banks, because all banks, in order to be a bank, you need to be a CAMA registered company. So there's an interplay that needs to happen between all those regulators. And what we've seen in certain instances is that perhaps the journey it hasn't been as smooth as perhaps it could have been, and you're having small hold-ups here and there already in the process. The regulation was issued at the end of March, so I think that it's just about almost 5 months now, but we're already seeing certain hold-ups in the process. And what ultimately needs to happen is that all of the regulators need to come together to work to work effectively. So I'll give you an example. Minimum capital, for instance, is a very big issue that issuers, both public and private issuers, are facing and are having to comply with and navigate that process at the CAC. You already spoke about the CBN process. At the SEC, they also have their own process. So whilst the SEC has moved extremely quickly and has been extremely supportive, at least for those issuers that we're aware of that are already in the market. So for instance, the application and processing time for applications has been significantly faster for people that are in the market to raise capital, particularly those banks that we've seen in the more recent past. But there are still further orders that people need to jump into. So when you finish the capitalization process, you still need to do a CBN verification process. You still need to go back to the SEC, and there are all those small hold-ups and hiccups that we're beginning to see in the process, and it's just imperative that everyone collaborates and works together.
Thank you very much. The hold-ups and the hiccups, I do see, because the CAC has also released some guidelines on documentary requirements from these banks that would help them along the process, the SEC too. I mean, with the hold-ups, I do feel like there's a show of readiness by them to actually collaborate. So I'm being positive and hopeful about that, because it starting okay, quite okay, that it just continues. Thank you very much, Ayodeji. So I would like to come back to Bimbo. The circular was very clear on its definition of capital and what constitutes capital, meaning just minimum paid up shares. Just paid up shares, basically. And it excludes reserves such as shareholders' funds and retained earnings. So it's really clear. So banks have to go to the markets and get this capital fresh. So my question to you is, what specific challenges are the banks likely to face in meeting the revised minimum capital requirements by March 2026? Because there seems to be a huge gap with where they are now and where they need to be. So what specific challenges, this is to Bimbo, what specific challenges are banks likely to face? Thank you.
Thanks. So I think so I work in a bank. So obviously I was caught by surprise when, the thing came out and you had certain things that were excluded from what constitute capital. So what you've seen historically is if banks were going to raise capital, they could do equities, or they could do some structured 81 instrument, bond, perpetual bonds. You've seen a variety of all of that. But in this instance, the CBN was very specific around how exactly you need to meet the requirements. And you can already tell right off the gate from what the transactions currently in the market that guys are already kind of towing that line. So you've seen the tested and trusted processes. So right issue, public offer. Those are kind of what people have been doing, which are the conventional methods. Because already you're kind of you're already in the box. And when the policy came out, bank had a specific duration to submit an implementation plan. So from day one, there are specific guardrails around how exactly you can do this. So you need to work within the ambient of what the CBN has said for you to meet the requirements. But I think what banks have then been doing is also being innovative in terms of ultimately how this can be done. So you think about it, and this is, specifically, so Fidelity, for example, came out to say they were doing a public transaction and a right issue, just trying to give themselves multiple options. So you had existing shareholders that can do a right issue, and then you also have a public offer. And if you also read some of the shareholder resolutions that have come out, you also see the language in there around, doing a private placement, etc., other options. But at the same time, there are still other options that could be pursued. So more within an holding company structure. So for example, you have a bank, you have an holding company, which has multiple subsidiaries, bank and non-bank alike. And I think even one of the banks already came out to say, you could explore a sell down in one of your non-banking subsidiary and almost upstream it to your holding company, and then down back to your bank as new fresh equity. So you could see bank kind of explore that route. You could also see banks raise money, a different kind of instrument at an holding company level, and then funnel it down to the bank in itself as equity, because ultimately it's the bank, even though there's a look-through element in there, the bank needs equity in itself. Another avenue is bank could explore, which we haven't seen as much, is M&A, and I think that's potentially maybe a downline, because all banks from the jump really want to maintain their current banking license. So the idea is, let's raise this capital as the first option, and then we'll explore what comes afterwards. So an M&A option is one banks could use to kind of, I wouldn't call it a challenge, but to kind of meet the requirements. And other ways could be licenses, downgrades. So you could downgrade either from an international to national, or regional from national to regional, as the case may be. So I think banks are smart, banks are sharp, and they know what to do. So I think banks understand what the CBN requirements are, and within the construct of what those are, they are really implementing strategies to really meet those already.
Thank you very much. Ayodeji, I don't know if you have any contributions to make to that question.
Well, the only I like what Bimbo said, and is very correct. Right now, most banks are essentially looking to sort of go it alone. If there's going to be, so even 20 years ago, when we had the last recapitalization round, it wasn't until it was clear that, look, we're almost at the end of the journey, that people started talking about an M&A play. I think that from where we are now, we're definitely going to see all of the banks try and come out and try and raise as much capital as they can, whether privately or publicly. And people are obviously looking at all sorts of options, whether it's through the OPCO structure or a license downgrade, like Bimbo said. But essentially to ensure that as much as possible, because if you look very, very closely if you look at the balance sheet, and I know lawyers don't like to look at numbers, but if you look at the accounts of the balance sheet of likely most of the banks in the market, even the so-called tier 2 or tier 3 banks, so we're not even talking about the largest banks. If you look at where their shareholders' funds are, is pretty close to the capital that they need to raise. Now, obviously, CBN has said that ignore shareholders' funds, ignore statutory reserves, and I'm just going to focus on pure share capital account. But that already tells you that, look, these are institutions that are already, so if I'm going for an international license and my shareholders' funds is maybe at 400, I'm already used to handling those significant funds. And from that perspective, people feel that, look, I should be able to sort of get enough funds to get my share capital sort of over the line. And the advantage is whichever way people go, whether M&E or capital restructure, hopefully there's plenty of work for all of us on the call, particularly the lawyers on the call. No issue. Apologies, Bimbo, but the lawyers want as much work as possible.
Definitely. All right, thank you, Ayodeji. I'm going to come back to you because we're going to explore the M&A route a little bit. But back to Bimbo, just a follow-up to the previous question. The circular is also quite clear on the fact that the banks need to still maintain their required capital adequacy ratio, that CAR, regardless of the fact that they are raising fresh capital. So how do you think, Bimbo, this obligation will influence their capital raising strategies?
Thanks. So, I think from the jump, the CAR is a function of, on one hand, your risk-weighted assets, so your loans, other instruments that qualify as your risk-weighted assets, and then your regulatory capital. So it's really those two elements that make up your CAR. So let's say, for example, as you already see, banks just go raise the capital. What that automatically means is, and this is looking at it from a day one picture, from day one, let's say I raise 100 billion, my regulatory capital already goes up. What that translates to is an automatic increase in my capital adequacy ratio, right? What really, I think the way I would think about it in terms of, what obligation and how this impacts is what then happens on day two. So when I mean day two is what happens in terms of how that capital is utilized that starts to impact your capital adequacy ratio. So you do a cursory look through the right issue circular perspectives of some of the banks already raising capital. You see reasons around, IT upgrades. You see things around branch expansion or working capital in terms of expansion of your loan books. All of these have different kind of impact on what ultimately your CAR will look like. So, if you were going a capital raising route, from day one, there's already an automatic increase in your CAR. But then what happens is subsequently how that capital is then utilized that really then starts to impact your CAR. Where it's a bit more nuanced is when a bank was to do an M&A activity, for example, because in that instance, there may not necessarily be fresh cash coming into the business from day one that results in that increase in your regulatory capital. What happens is, but on the other hand, your risk-weighted assets goes up, right? All your assets, because you're combining two banks' assets, those two go up, but your capital depends on, so let's say I do a share for share exchange, your capital doesn't necessarily grow up in tandem. So in that instance, there's now the conversation around how best do you then structure the M&A transaction in a manner that doesn't necessarily put overwhelming pressure on what your CAR ratio would look like. So I think so the way you think about it is on two sides. So on one side, you have your banks raising fresh capital. I don't imagine that impacts you from day one in terms of CAR. Your CAR goes elevated, but then subsequently it then starts to fluctuate based on how you utilize the capital. It's then with M&A that it becomes more nuanced, where there's a little bit extra caution in terms of how you structure the transaction such that post the completion of the M&A transaction, your CR is still at a level that is adequate. Your capital is at a level that is adequate. The assets, the size of your balance sheet is at a level that is sustainable, because your CR is really solving for your credit and operational risk. So those are kind of the elements that needs to be baked in ultimately in terms of how you structure a deal, be it M&A or you raise your capital to still stay within the construct of what the CBN has directed.
Thank you very much for that, Bimbo. Now coming to M&A, coming back to Ayodeji, our M&A expert. I mean, there have been lots of conversation about this and about this subject now, current, and just people foresee a lot of mergers and acquisitions. And I mean, the last capital raising exercise started from about circa 85 banks, and they reduced to about 25%. There were a lot of mergers and acquisitions then. So now it's, well, let's say, inevitable in this exercise as well. So for Ayodeji, what are the key considerations for a successful M&A in this period? Because bear in mind, smaller or mid-sized banks are maybe in a tougher spot than the bigger banks. Like I think Aramide mentioned that they already know investors, they already know them sort of. So smaller banks now are they may have it tougher. So what should they consider now what considerations should they have for a successful M&A basically in this period? And not just smaller banks, all the banks are just trying to make the point.
Okay, so 2 questions. I'll answer the first part of your question. I think that we're very different from where we were 20 years ago. So in 2004, capitalization, I think at that time was 2 billion. It was taken to 25 billion. So it was almost 12.5 times what it needed to be. And if you look at what banks were sort of struggling with then in terms of the relative size of quite a few of our financial institutions, now I think even though it's been raised significantly, so now capital was meant to be 25 billion, but it's been taken to about 500 billion. But I think that in that 20-year period, what has happened is that Nigerian banks have actually grown significantly in terms of where they are. So a few moments ago, we were just talking about the shareholders' funds, and I know that Bimbo alluded to it also. If you look at where the shareholders' funds of all your tier 1 banks are, all your tier 1 banks minus 1, and those people on the call know what I mean by that statement. You see that for most of them, they were essentially close to 500 billion. Now, even for your so-called tier 2 or tier 3 banks, because of where it is, people essentially feel that it's easier to go out in this market. And then also our markets are also more developed. Our pension industry also is significantly more developed. So you have virtually from your tier 1 to tier 2 to tier 3, a lot of them are already quoted, a lot of them are already listed, which hadn't happened before. Quite a few banks have actually even also issued a Eurobond instrument, which those are debt instruments and not applicable, but you've seen people actually have significant capital sort of flow through their doors. Now, in terms of the downside of the M&A, or what people should look at, I think that when you're considering any M&A deal, there are a whole host of issues that you need to, there are a whole host of boxes you need to tick. So there's regulatory things like CBN, SEC, NGX, if you need to list the shares, CAC increasing capital, less so. I think that from the regulatory perspective, what we've seen from those processes, there's tremendous regulatory support. So it's clear that if anybody comes to them with an M&A story that makes sense, I don't see the CBN saying we're not going to approve it, or we're not going to approve it in record time. And I think the same would also apply for the SEC. So that's the part that usually gets advisors slightly more concerned. Even if for your merger transaction, our laws are structured that, you need to have a court-ordered, a court-regulated process. Once again, going up before a judge to tell the judge that, look, all judges know the CBN has increased capital. okay, I need this to be able to survive so I don't sack X thousand number of employees. It's something that a judge would grant as a matter of course. Now, that's the other part. Now, is the softer part that people now need to pay a lot more attention to. So it's things like basic things like due diligence. Because if you look at the mergers that went through, all the mergers 20 years ago, all of them had issues here and there, but it's things like being able to understand the non-performing loans. And I think Bimbo alluded to it as well, the non-performing NPL numbers of the counterparty. It's one thing for someone to pull out numbers to you. It's another thing to actually then go into the entity and then understand that, oh, the numbers are significantly larger than they need to be. So it's things like insider related loans. It's things like that that potentially cause issues, because ultimately, remember that two or more entities are coming together to try and meet a regulatory threshold. So if one person says, so let's assume it's a national threshold, cap is 200 billion. One person says, I'm at 120. Another person says, oh, I'm at 150. Or another person says, I'm at 90. Now, both of these people have already gone out to the market and they've tried to raise money, and they haven't been so as successful as they thought that they would be. Now, normal math tells us that 120 plus, say 150 takes me to 270. But the question then is that by the time we go into it and you do a CBN examination or your first year of audited numbers, do you need to write off additional loans, additional numbers? It's those sort of things that, sort of puts people slightly at ease. Then you have even softer, more cultural issues that, things like, we're in an African society, so some of these things matter. Who is going to be the chairman? If I'm merging with either, obviously I'm more senior to us, so the assumption is that I will be chairman, or we should be chairman. Am I going to nominate someone that is going to be the CEO? And you've also seen how conversations like that in one or two institutions have played, whereby you hear that, someone fell foul of the powers that be, and you hear a removal here, a reinstatement here. Who is going to be on the board of directors? It's things like that. What will be the surviving entity? Because it's two entities coming together. Is it the person that had 120 billion that will be surviving entity, or the person that has 150 billion? Are there tax issues that you need to sort of grapple with? Is there contingent liability? There's so many things that potentially you can trip up people. If the liability hasn't arisen today, is it contingent? There's those are some of the things that ultimately one needs to pay very, very close attention to, and actually figure out that, look, is it worth it, or is it easier, for instance, like Bimbe alluded to, that rather than trying to say that we're trying to match to create an international bank, if all we have is that you have a subsidiary in Ghana, I have a subsidiary in the UK, does it make more sense to just sell the Ghana subsidiary, you sell your UK subsidiary, we bring in the money, and we actually then try and see that, are we then able to then meet that, the actual capitalization requirement?
Thank you very much. Actually, very interesting, because the point you made about the small things, my question really was due to the rush with that of the timeline, basically. Many institutions may overlook. I know we're all professionals, but they focus on other things. But the smaller things that you mentioned, that is really what I was getting at. But you answered that quite nicely. Thank you very much. Now I'd like to move on to Aramide. So my question to you now is, what are the implications of the current high interest rate environment on the attractiveness of equity versus income securities? And how would you say banks should navigate this when planning their capital raise?
Thank you very much, Ida, for that question. I think Bimbo had actually touched on it earlier when he spoke about yield. So just to answer your question, high interest rate environment enhances the attractiveness of a fixed income instrument as against an equity instrument. And just continuing from where Bimbo landed was the fact that there would be higher yield on new fixed income instruments, which will be more attractive to investors looking for a stable return, rather than equities, which is associated with, which is known to be slightly volatile in terms of pricing. So the implication of that higher yield and that interest, a higher return for investors, you and I, is that we're more attracted to investing in fixed income securities such as bonds. So there is that reduced demand for equity. There is that limited market liquidity. There is even a potential of suppression of share prices as a result of this high interest rates. What we also find with this high interest rate is that it does also have an impact on the borrowings of this entity. So the high interest rate also has a high borrowing cost. So the implication is then it then affects the profitability of the companies or the banks as such, because once there's a higher borrowing cost, it affects the balance sheet and also has an impact on the dividend yield as returns to equity. So these are all the stories and these are all the thoughts that would go through the minds of investors in considering, should I buy and should I purchase an equity instrument or should I purchase the fixed income security? And what you then tend to find is that investors, institutions would then rebalance their portfolio and try and leverage on the fixed income securities because it is very lucrative presently. However, taking that into consideration, because what I have now said is it shows that the fixed income securities are at least the newly issued ones, a bit more attractive than equity. So now there is now a higher burden on the banks to actually take into account and consider pricing strategies that would still make equity very attractive. So I think Bimbo also alluded to this and saying that you need to find a way to make or give incentives to investors as to why they should purchase your security or equity over the fixed income securities. You also need to then think on how to improve on your credit rating, because this also has an impact on how you price. So if you have a good credit rating, that can also be an incentive as to why I should buy the shares. Also, there should also be a diversification of investor base. And this is something I think, particularly in this 2024 recapitalization, that a number of investors, a number of issuers are considering. So we do know that there are certain issuers that are less likely to be concerned about the fluctuations of the interest rates and are in there for the longer term. So the expansion of the investor base is very critical to this success, or it's very critical, particularly the high interest rate environment. Also, the strategic use of the proceeds. And we tend to find that this is very key and important to investors. So how are you using the proceeds? What are you using the proceeds for? And what we've seen that banks are considering is using the proceeds for high returns projects, which would then offset that borrowing cost. So there is always going to be an increased borrowing cost as a result of the higher interest rate environment. So the way of mitigating that increased cost is investing or using that proceeds to invest in higher returns projects to offset that mismatch in terms of that. Then you also have transparent communication. Just essentially, I think everyone keeps reiterating. And I don't think during this process, what we've seen is that the importance of a robust investor relations department or unit cannot be overemphasized. So undertaking investor roadshows, undertaking stakeholders engagement, having that one-on-one interaction with shareholders, because there are certain concerns that people have with investing in equity. And the job is for issuing houses, for financial advisors, for issuers to find a way to smooth that sale and to ensure that we achieve our target, which is to recapitalize. Even if it's 500 billion, 200 billion, 50 billion, the target has to be met one way or the other, regardless the environment. So it could also be staggered. I know everyone is rushing in now. So a number of issues are out. This person is out. This person is closing. It could also be taking a phased approach. So a number of banks are going now. Why don't I wait? Because you do have time. So obviously start early, but also plan right. Know when you're going to the market. So timing consideration, market consideration, very important. Thank you.
Thank you very much, Aramide. I think a common thing that all speakers today have said is the communication and transparency, letting the investors know how and what they're going to use their money for. And yeah, just carrying everybody along. That's something that I've noted. Thank you very much for that. We're moving now to Ayodeji, back to you. This is just trying to do a comparison. How would you say the Nigerian banks' compliance and governance requirements differ from those in developed markets or more developed markets? And what best practices do you think we can adopt from them?
Okay, so in terms of governance and compliance, requirement, what I'm going to speak more because we don't sort of move away from the topic. I'm just going to focus on in terms of the capital raise. So in terms of the capital raise process, I think that if you look at our process and the process in the international market, one word you used was that, look, there's a lot more transparency. Not because in this market we're not transparent, but if you look at the prospectus of the actual selling document and you sort of hold it side by side with our own document, you see that your typical international selling document sometimes is 5 or even 10 times as large, even for a Nigerian issuer than you would have. And one of those things is there's a whole slew of disclosures that are there because the market is a lot more sophisticated and there's a lot there in terms of size. It's also infinitesimal times the size of our own market. So if you're going to that market and you're trying to raise capital, the level of disclosure is extreme. And issuers are also required to even put in things like risk factors. So typically, if something happened, sometimes you try and talk down things like, oh, this is not really a problem if you were doing a Nigerian process. So a very good example is the windfall tax, for instance, and we haven't alluded to that. If you are running a Nigerian process, you're probably trying to explain that, where it's not going to be as significant of an issue. When you're running an international process, you want to put it all out there that, look, this thing is there, it could have this impact, and just so that people are ultimately aware of the impact of the process. Then, even in terms of our actual procedure, there are a number of additional nuances. So our market is very much payment upon application. You're applying for shares. If it's a 28-day process, the day you fill your form and you submit your form to the stockbroker or to representative of the issuer, that's the day you're expected to do a transfer or give a check to the receiving bank. Even though the process is not over in an international, and then you need to sort of wait for an elongated period. We've already spoken about after your offer period closes, there's a collation period that may take a number of weeks. Then you need to go to the CBN for capital verification that may take a number of months, and the jury is out as to how long that process will take. And then you come back to the SEC. They may take another couple of weeks. Then you go back to the C. I can see that you're sort of wondering. Oh, then you come back to the CAC to do the allotment of your shares. Then you go back to the NGX to say, okay, I finally come. The baby has been born. Come and list the shares. There's just so many things that, and on the back end of that, registrar is updating register, and so many things are happening. And the expectation is that, so if for any of our attendees that, for instance, have applied to or have participated in any of the public offers or rights issues, they've already parted with funds, and you ultimately don't know how quickly those shares are going to come, whether it's going to come in a couple of months or even at the end of the year. Meanwhile, for an international process, what tends to happen is that the process of allotment and issuance of shares is significantly faster, and the expectation is that, look, it's more of a book build process, and you're actually making payment. just before the shares actually come to you. So you're not telling your underlying investors that, oh, I've sent your money to Nigeria and we're waiting for them to finish their own process. Another nuance that we see in our market is most of our attendees we're all aware of the CCI process, whereby, you know, for international investors, you're bringing in cash, and typically what happens if you're running only quote and unquote a only Nigerian process, and most of the issuers, even though you have international investors participating, but it's largely a Nigerian process, which means that your receiving bank is a Naira. So just for anyone who doesn't know, what happens is that a commercial bank is appointed as a receiving bank, and any money that stockbrokers, issuing houses get for the process, for the public offer, sits in an account with a receiving bank account. The receiving bank would not be the bank that is trying to raise the capital, just for purpose of transparency. Now, if an international investor is participating in our own offer, for instance, what would happen is that, oh, you would have to send in your foreign funds, get a CCI, and essentially wait through that process. And if, God forbid, you didn't get the capital or all of the shares that you were meant to get, then you get cash back, but which is Naira. And what if there's been a significant devaluation? You know, those are some of the things, those are some of the questions that are sort of being answered. And in an international process, you don't necessarily go through all those hoops and jumps, because the expectation is that, look, allotment is almost instantaneous. You came to the market to come and raise capital. The expectation is that you have all of your approvals in place, and you're talking to sophisticated investors, and there's not an additional layer of vetting for some of those investors. So those are just some of the compliance/governance requirements that we sort of see, or some of the nuances, as opposed to from a Nigerian process and an international process. But in terms of core compliance and core governance, I think that to a large extent, our Nigerian institutions do well, because even some of these institutions that are already in the market, and I don't want to name any institutions, you see that quite a few of them already have subsidiaries in the more developed market. So it's not unusual for a very large Nigerian bank to have a subsidiary in the UK, which means that somebody is regulating not only that subsidiary, but they're also watching what parent is doing in Nigeria or in the US, for instance. So you're already seeing some of our institutions trying to adopt what is best practice, both locally and also internationally, just to try and ensure that we try and mirror and we try and mimic much more closely to what happens in the international markets.
Thank you very much, Adedeji, for that answer. And well, we're almost out of time. Thank you to all our speakers. I mean, we could go on for the whole day, but we will not. So we have two questions that we're going to take from the chat box. And I'll just start. I'll read them out to the speakers. They're not directed towards any speaker, but anyone can jump in. So the first question, what are the actual and real benefits of buying bank shares? And how can somebody confirm that shares are allocated to person / proof of share allocation? That's the first part of the question. And then with the dwindling value of the Naira, is it still advisable to buy the bank shares? That's the first question. Anyone care to jump? Chime in.
Okay, I lost a bit of what you said, but okay. But I assume the question is about whether or not one should invest in bank shares.
Yes, that's like the latter part of the question. So the first, I'll just summarize. So the actual and real benefits of buying bank shares, and what is it still advisable to buy shares with the dwindling value of the Naira?
Well, my own take, and I'm not so I'm as a lawyer, I'm full caveat. So I'm not an investment advisor like Aramide and Bimbo. But my view is that I think that it's extremely important, and I think that it's also useful. If you look at the state of the economy, and this is not a macro session, over the course of the last 20 years, we had a very, very vibrant equity market, and it sort of died down, and we haven't really had a very active equity issuance process. Now, I know we complain about cost of living, but part of improving cost of living is also for aspiring middle class or people in the middle class to ultimately own significant stakes in our actual businesses. So whether you hold it directly through buying shares or whether it's through your pension funds. And I think that there's limited downside. Now, obviously, you would need to do your due diligence. Lawyers, I assume the person that asked is a lawyer. Apologies if the person is not. Lawyers tend to like reading. So there's enough information online. All the prospectuses and all the rights issues are online. So you can start by even taking rights issue of company A, bank A, and public offer document of B, and sort of compare apples to apples. You know, there's enough information online. You can go back, look at their financials, but I honestly don't see what you stand to lose by investing in it, particularly by investing in it. Now, it may take a bit of time before the shares are ultimately get you, and I spoke about that in the last question, but one of the advantages I think for all the banks that have come out, all of them are publicly quoted, which means that on day X, whichever, even if you decide to exit, you can easily go to the market, you can sell the shares. The downside is that, okay, maybe the shares have lost value by maybe 10%, but the truth is that ultimately devaluation is a fact of life. What else are you going to, what are you going to do with your capital? So that's my pitch. I would hand over to Aramide and Bimbo, who clearly are more able to answer this question than I am.
Yeah,
So
Aramide,
contrary, I'm not an investment advisor. Before somebody holds me by what I say outside of here. These are my views. They are not my company's views. They are not any entity I represent. I mean, so I guess it's a function of really what the risk appetite of the person is. So if you are a risk savvy, you like to get some exposure to an equities, obviously Naira equity, and you also want some diversification benefit at the same time. I think it's worth considering with banks. And when you look at the stock exchange in itself, it's probably one that when you look at the components, banking stocks are one of the most traded. So in terms of your liquidity, it's the ease of entry and exit is there. And then the price appreciation is also there. So you could either do two things. You could either invest directly, or another avenue is there are ETFs that gives you the flexibility to be exposed to a basket of different stocks. So different banking stock if you don't want an exposure to one stock. But really, I think Ayodeji rightfully mentioned, it's really a function of you doing your due diligence, doing a function of your own assessment as to whether you are willing to bear the risk that comes with that particular name. And I'm not necessarily a buy now, sell now, kind of investor. You have to take a long dated view to invest in. I almost look at it of holding a stock through the cycle and not necessarily when the price is, because, I think there's a popular saying, the stock market is very, very rational, and you can remain, how exactly is it? So you can be more irrational than the stock exchange ultimately. So your stock exchange can go in a 1 year period, can move 10% up and down. But you really then need to say, okay, if I'm holding this stock for the longer term, then I'm willing to ride out that terrain. So you almost need to take a long-term investment view towards this thing and think about it as opportunity to diversify amongst other things. But it's really a function of, no, I don't believe anybody would, because I mean, we are clients will sell you what the rationale for doing this, but as much as we will say, do this or do that, you also have to have your own conviction around why exactly you want to do this. But I wouldn't recommend, just buy now because of what you think around, in a week's time. And I think the other element to also add is the benefit that come from a dividend perspective, because Nigerian banks have been one of the entities on the stock exchange that consistently pay dividends. So when you combine like the dividend yield and you combine the share price appreciation together, you on a total return basis, it's probably one of the best few investment options on the stock exchange that you could get.
Thank you very much, Bimbo. Thank you, everybody. We actually got some more questions, but I'll share that with the speakers later and try to get the answers. So we'll be closing now, or pastime. Just thank the speakers once again, and I'd like to hand over to the first chairman, Mr. Oladele Oladujoye, to give a closing remark. Thank you, everyone, once again. It was really lovely speaking to you.
Thank you, Ida. Just before Dele, just to let all our attendees know, we've taken note of the 7 questions. We would get the responses from the speakers and email them to all of our members. So if your email address is not on our list, kindly reach out to the SBL Secretariat so we can add you to our mailing list, and we'll send the responses to everyone after this session. So over to Dele Oladujoye, the first Vice Chairman of our committee. Dele, we can't hear you. You need to unmute. SBL, please, can you unmute Dele? Okay, great.
Right. Thank you, everyone, once again. I said earlier that I didn't realize it was literally past 3 because I was having such a good time listening to the experts share their perspectives. Personally, I'll say thank you to Aramide, thank you, Bimbo, thank you to Ayodeji, our former chair of the SBL committee. I know we've learned a lot. I've learned a lot myself, in spite of what I thought I knew. These sessions always give you a chance to sort of broaden your knowledge and learn more, and I'm really grateful for the time. I thank the participants. There's value to be learned, but also if there was no one listening, then the effort would have been in vain. So I thank the almost 200 people that joined us today on this session. And lastly, I'll say a big congratulations to the NBA-SBL on the 20th anniversary. The impact the SBL has made on the profession is not one to take for granted. And I wish all of us the best for the remainder of the day. Thank you, everyone.
Thank you.
Thank you.
Thank you, everyone. Have a good rest of the day. Thank you.